Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yeah. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
So let me share my screen. And as I do this, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching and he'll read it back to me. And to give you guys a chance to put those questions in, we're going to take a couple minutes, look at the pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. Okay, so pre-market report. These are stocks trading in the pre-market hours. We have this calendar view up top, and that does allow you to click on a historical date and see what happened in the pre-market hours on that particular date. Today, we're on December 7th, and so far, we have 451 stocks trading higher in the pre-market hours, 294 stocks trading lower. As far as volume goes, we got 143 million shares trading on up volume versus 131 million shares trading on down volume. And if we convert that volume to dollar value, we have $2.4 billion worth of stock trading higher versus $696 million worth of stock trading lower. So from that high level, looks like the pre-market trading, at least, is indicating that there's some bullish sentiment in the pre-market hours. Let's take a look at it from a couple more perspectives, and then we'll move on to questions. I'm going to come down here, and we have a list of our most active stocks in the pre-market hours, our biggest percentage gainers, biggest percentage decliners. You got 59 stocks that made our percentage gainers list, 42 on our percentage decliners list. And this is a list of stocks that are trading in the pre-market hours. And in order to make this particular list, it has to meet certain thresholds because stocks in the pre-market hours are less liquid. Sometimes they could trade as little as one share, right? Or a lot of shares. And so we set certain thresholds to make this list. We're looking that there's activity, liquidity, and actual price movement. So in order to make this list, it has to meet our thresholds. However, the initial list, the unfiltered list, will have stocks in there that are low cap stocks, ETFs, could have leveraged products. So any security that's listed on a major US exchange, if it's trading in pre-market hours and meets our thresholds, it could make this list. So to narrow down further, we could use the filters above. If you have a watch list, you can filter by your watch list, or you could filter by all your watch lists by using this filter here. We're going to use this one in ETF as an example. So I'm going to click on that. You get a drop-down menu, different ETFs to choose from. We're going to select this one, SPY. The SPY is the S&P 500 ETF. And what happens is that the list below gets filtered by stocks that are holdings in the SPY ETF. So these are S&P 500 constituents. And as you could see here, we have 11 stocks that made our percentage gainers list and 2 on our percentage decliners list. So this also indicates that so far the pre-market trading is indicating a bullish bias in the early morning. So that, you gave it a couple minutes, Will. If we have any questions, I'll take them now.
No questions have popped up yet.
Okay. So let me default to SPY. Do we have any? We didn't have anything yesterday left over either.
Nothing was left outstanding. I actually checked the chat from yesterday. There was no outstanding question.
Okay. So I'm going to come back just to this one report, which we talked about yesterday. And this here it's a report that shows all the different stock symbols that have options volume, right? So it's like this big report we got. You could see 5,793 stocks yesterday, that trade options. And this keeps track throughout the day. It aggregates the options, and I think the default is by notional, but you could switch here by volume. So you could see here it's auto sorted by, I think the list is sorted by the highest volume in notional terms, highest option volume in dollar value. So Tesla makes the top of the list, trades $4.65 billion worth of options yesterday. And you could see the next one down is SPY, 1.29 billion. And then you could see how they start to drop down as you go further down the list. And next to it, we look at, well, what is the average daily volume in dollar terms, right? So in Tesla, this is an example, 4.65 billion. On average, it trades almost $2 billion worth of options. So on a relative basis, this is saying it's more than 2 times its average daily volume in dollar terms, in notional terms. And this is the breakdown in calls versus puts. So you could see that a lot more puts traded than calls if we use the dollar value. Let me take a look here. If we use it as a straight volume, just contracts, right? And keep in mind, like certain, you have options that could be $9, and you could have options that could be a penny, right? So that's why we kind of compare where's dollar versus number of contracts. So you could see that if we just looked at the contracts, it's more even, right? Almost, actually, there are more calls, right? If we just look at the number of contracts, there are more calls that traded than puts. So that's the difference. So you could see 47% of just the volume is in the puts. But if we switch it, we could see that based on the dollar paid, much more of it was in the puts. So it could be like deep in the money puts, some kind of spread, whatever it is, that could have impacted that dollar value. All right. But that's the difference. Now, then we kind of go and take a further breakdown in how the options traded, because when we look at options, you could place orders for a straight call or straight put, but you could also use options for strategies, and strategies are like a call spread, vertical spread, time spread. A lot of people use some people use butterflies, iron condors. So there are all these different types of strategies that you could use with options that doesn't have to be a straight call or straight put. All right. So that's the difference between a single leg and a multi-leg. So multi-leg, so these are just, the trade was either a call or a put. That's it. But a multi-leg trade, which is over here, that involves more than just one option. The trade itself is a combination of options. All right. And that could be two options. It could be three, four. It could be anything that's, two or more would be a multi-leg trade, because that's how you designate it. Now, if you're using your broker, right, a lot of brokers will allow you to put in a multi-leg trade that they have to get executed simultaneously or not at all. In other words, you don't want to leg into a spread. Let's say you're doing a call spread. Well, you could enter in a call spread trade. You don't have to leg into it by doing one and then trying to get filled on that and then putting in another. You could enter in a order type that says either I get executed on both at this price or not. Okay, because I don't want just one part of the leg. So those are the multi-leg trades. So it depends that both of them get executed or none of them get executed. Or more. It could be more than two options. And these would be in the multi-leg. So this is the breakdown in the volume. So this is just looking in the not the notional, but just the volume terms. You could read it up here. The percentage of all the trades that were multi-leg. This is the percentage of the trades were just regular way call or put. And then over here, we're talking about the contingent trades. And the contingent trades, those are trades that typically involve a stock or tied to a stock. It doesn't necessarily have to be, but that's typically what it is when you do the trade. So a buy right that you enter and say, well, if I want to do the buy right, I want to get executed on the call and the stock simultaneously. I don't want to leg into it. I don't want to just do the stock first and then try to get the call, because the stock could move and then I get a worse price. And I don't want to do just the call and then try to get the stock, because if I do the call and then the stock moves against me, then I'm going to do it at a worse price. So these are things that you want to execute simultaneously at some, price that you designated, and then it's contingent. So that would be a contingent trade, but it doesn't have to be just a buy right. It could be a delta neutral trade. It could be a trade where you're saying, well, I want to, I have this put, I want to buy this put, but the put has a 50 delta, right? So let's just say you want to buy 10 puts and this put has 50 delta, right? So now if you buy the 10 puts, you're short 500 delta, right? Because you bought 10 puts, they have 50 delta. That means that, what does that mean? You have some risk. You have a delta directional risk right away, right? So if the stock goes up, the put is going to lose value. If the stock goes up, it's going to gain stock. If it, so based on the delta directional risk, you may want to hedge it, because the purpose of buying a put may be that you think that the implied volatility is very low, or you think it's a good implied volatility, and that's why you're doing the trade. You're doing the trade because you want to trade that volatility, and you're not looking to be long or short direction, right? So what you want to do is strip out the directional risk or mitigate it, and hold on to that volatility exposure. Okay, so if you want to just trade the volatility, that means you're going to have to hedge your deltas off. But if you go out and buy the put, you can buy the put and then you can go out and buy the stock. And if the stock, maybe it's in the same place, then you got your hedge off. But what if you don't want to what if you want to do them simultaneously? And you say, I'll buy this put, but I want to hedge, I want to hedge the initial hedge, right? The initial delta, I want to have that tied to the trade. So that could be a contingent trade too, right? So you could say 10 puts and 500 shares of stock, long 500 shares of stock. Well, that's contingent because somebody then has to do that trade and deliver both, right? They have to deliver the stock to you and deliver the option. And it doesn't have to stop there either, because that's an example of just a call or a put in stock. But let's say you have a different strategy with two legs. What if you did a spread, but the spread has a delta? Well, if you designate that you want X amount of stock with the spread, that would be a contingent too. So you could have then a multi-leg. You could have a multi-leg trade, right? A multi-leg trade with stock contingent, right? So then you could have more than one option, and you could say, I want this X amount of stock. So now you have a multi-leg trade with a contingent. So if we look at the contingent trades here, for the most part, let's go back up to, I'm going to sort it back to the most. We don't see them. Here's a 10% one. So in IWM, there's a very big one yesterday. 10% of the volume, of the option volume, had a contingency tied to it. Okay. So that might be big. Here's 9%. Okay. It doesn't have to be one trade. It could be different contingent. There could have been many contingent trades in there. I don't know. It could have been one trade. It could have been many trades. But 10% of the total volume had a contingency tied to it. Here's a 9%. So, with those contingents, we don't, at least, on a daily basis, they don't make up a big part of the volume. Sometimes you see, some big ones that don't, and usually it'll be, what I see is, if people do buy rights, those are common. Or if you are doing a big trade, right, you might want the stock contingency because, if it's 100 shares or 200 shares, you could probably get the stock and it won't move that much. But what if you want a lot of shares? If you have a big options trade and, you need 200, 300,000 shares of stock to be delta neutral, well, then you're taking a risk, because sometimes that's not that easy to get all at one price, or if the price moves, it could be big dollar value. If that goes against it. So to mitigate that risk, you may want to do it with a stock contingency. And we could take a look at, which one did I say? IWM. I'll take a look at IWM, see if we could find, if there was any particular big trade in IWM. Well, let's do that. I'm going to come over here on the option blocks trade screener. And what we'll do is, we have all these options trades in here, but what we'll do is take a trade stock contingent. All right, so I'm going to look for all the trades that have stock contingent. Let's look for IWM. So in IWM, we do see a lot. So there were like 30 of them, right? So we see that some of them, though, these are stock contingent trades, have pretty big volume, 15,000. You can see $1.4 million worth of options, 8.6 million. So let's just take this one over here, right? Here's one in IWM. So we could see that these two happen at the same time, 321.39, right, on the CBOE. So this one here could be interesting because to me that looks like, well, both of these options are probably related, and they're very big, and it has a stock contingency. So my inference here, right? My inference is, okay, these two 15,000, these two that are 15,000 are part of the same trade, and they have a stock tied to it. Okay. So let me see if we could find that. Keep that in mind right now, these two. And so what can this be, first of all? If you have these two options, well, they're the same strike. So you could be buying both or selling both, which would make it a straddle, or you could be buying one and selling one, which would make it a conversion or a synthetic, right? So if I buy a call, sell a put, it's a synthetic long. If I sell a put, buy a call, sell a call, buy a put, synthetic short, right? It's like being a synthetic long stock or being synthetic short stock, or if I'm buying both. So it could be two strategies. It could be a straddle, or it could be a synthetic. We don't know. We don't know for sure. We could look at the bids and offers and maybe make an inference that this was probably buying a call on an offer, selling a put on the bid. So if we just went off that and said, this looks like they were getting long the call, selling the put, it's a synthetic long on the 180 strike, right? We don't know for sure though. But did they hedge it? And how much shares did they hedge? So let's take a look. And this was a floor trade we see here. So let's go over here and just try to figure out, maybe from the contingent stock, IWM, right? And wait, well, what was the time on it? This one, 321.
I think it was. Yep.
Okay. So here we have, let me just go back for 1 second. Let's just make sure that I'm going to try to match up the times, because they're not always exactly the same time, but let's just try to match up the times here. So stock contingent, which one was it? IWM, right? So here it is, 321.39, right? So now I need to find the contingent stock. Like, what do we think happened here? So if it's a conversion reversal, synthetic stock means it's the delta is 1-for-1 with the stock, right? So it's 1.5 million shares, right? That's what, because 15,000. So if it's a straddle, well, a straddle would have a different delta, because you're either buying both or selling both. So if you're buying both, there's a long delta and a short delta. So some of it would offset, right? So let's go to 321.39. That's what we want to find. I'm going to go to the stock contingent here. Let's go to IWM. All right. And I need to find it at 321. So this one is the closest right here. Right. So they put it up 1.5 million. So what does it look like to me is that it was either getting long the synthetic and short the stock, or getting short the synthetic and long the stock, right? So that's what it looks to me based on just the amount of shares, right? Because you wouldn't need this much shares if you just did the straddle. So this looks like, based on the delta of that trade and what I'm seeing here, that this is a conversion or reversal. This is a conversion or reversal. And why would they do that strategy? Right. So why would they do that strategy? Well, it's either an interest rate play or dividend play. Right. That's the conversion reversal. It's either an interest rate play or dividend play, or they need to be long the stock for some reason. Maybe they want to be long the stock to offset some of the short, but there could be a couple different reasons actually besides that, but typically if you have no position, if you have no prior position on, then it would be either an interest rate play or a dividend play, because now you reduced that strategy to, you took off the directional risk because you hedged it off. The gamma, the vega risk, the theta risk, that's gone because you bought and sold on the same strike, and you reduced the exposure of the strategy to the cost of carry. Okay, so that's how we looked at and analyzed that particular trade. And the idea is to take the volume, so this is 10% of the volume, right? This is 10, all the contingency trades were 10% of the volume in IWM, to understand what people are doing, why potentially they might be doing it, and to break down that trading volume. And if you're trading IWM, you want to know what's going on, right? So we're right up at 9:30. Well, I'm going to leave it there.
That was awesome, D. Great job. Thanks so much for the description. Thanks everyone for joining. Have a great day. Thanks again.
Thanks everyone. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Have fun, everyone. Have a great day. Bye.